statistical, mathematical fact
never has been down.
has broken every single record. There is no asset that has come close.
It's the only thing in the industry that was not touched, that was not hacked, and it never fails doing what it promised in 2009. It's never
What's
failed.
the best performing asset the world has ever seen? And you'll find out that it's Bitcoin.
Good morning, good morning, good morning, good afternoon, good evening, wherever you are piping in the world. Welcome to another live space with Oliver Velez. Of course, my name is Oliver Velez, and I'm trying to raise your level of sophistication regarding the most innovative, the most life-changing, the most wealth-generating asset we have ever been exposed to in our lives. In fact, I believe that Bitcoin is the greatest opportunity the human species has ever been in contact with. And I've constantly done my best to try to get you to see or understand or believe is that we are extraordinarily fortunate. And I believe that you and I, all of us, anyone who's listening to me right now, we can consider ourselves amongst the most fortunate human beings who not only have ever lived, but who ever will live. So I believe that this is such a unique time in this new world, which I believe that Bitcoin has sort of burst on the scene with, that this time is so unique that no other human being that's ever lived before us has this opportunity to actually witness the birth of Bitcoin and its first years of practically freaking taking over the world. And so no other human being has, outside of our time period, no other human being before our time period was fortunate enough to live during this time. And no other human beings for eternity that are born after this period of time will ever experience what we're experiencing today, will ever have the opportunity that we have today. When this epiphany hit me and in the early part of 2020, I actually decided to dedicate a portion of my professional career, a career that's been going on for 4 decades plus. And I decided that I'd dedicate a portion of my time, a portion of my career, a portion of my skill, a portion of my talent to helping others see this, have this epiphany, to others seeing this for what it really is or what I believe it to be. And so I am here today, as I always am on my live spaces. I'm here as sort of like that, one of the few voices, I believe, that are one of the voices that are trying to say to everyone, wake up. Now, there are many voices in the Bitcoin space, I would say, and they're increasing by the day, especially since the bear market decline of 2022 is over. Bitcoin is up. What most people don't even realize, that Bitcoin is up nearly 170%. Year to date, it is up nearly 190% off of its cycle low. Think about these numbers. Bitcoin is up nearly 170% year to date. It is up almost 190%, I believe, from its cycle low, the bottom of the bear market in November of 2022. It is up over 100%, I believe, if I'm not mistaken. It's up over, no, it's up over 106% over the last 2-year period, it is up over 1,600% over the past 5-year period. And it's up over 500,000% over the last 10-year period. But since Bitcoin's bottoming out in 2022 and its meteoric rise off the low, the numbers of voices in this space have only increased, the numbers of so-called experts. But the vast majority of the voices that I hear talking and about Bitcoin and focused on Bitcoin are having you look at this asset as just another asset. The vast majority of people who speak to you, they speak to you within the confines of the traditional finance industry. They are encouraging that you add this to your mix of other things. They are looking at it as just another ancillary item, an exciting one, but an ancillary item that you add to the mix, like another ingredient that you add to a recipe to give your meal a tiny bit more flavor. And I think that Bitcoin is far more than that. I think that Bitcoin goes far beyond being something that you buy for $1 and sell it for $2. That I believe that it represents freedom, and that freedom should never be sold. That freedom can't be looked at like all of the other assets that you have accumulated in your life. That freedom supersedes every single thing else. And a lot of people say, well, Oliver, what do you mean by Bitcoin is freedom? Freedom from what? Freedom from debasement, freedom from theft, freedom from having to work your entire life for a coupon that was created by another man, that a coupon that is controlled by another man, a coupon that is debased on you, that you have to spend over half of your life giving your time, your effort, your energy, your skill, your knowledge, your know-how. You have to give your life to a money that was created by another man. I do not believe that we were brought on this earth to work for other men. I just don't believe it. I don't believe that the plight of almost every single human being should be to work for a piece of paper that was created by a small group of men, that is which paper you work for is dictated by where you're born. So if you're born in Europe, the piece of paper that was created for you was the euro. If you're born in the United States, on that plantation, the plantation called the United States, well, the coupon that you must give your life to is called the dollar there. If you were born in Argentina, up until now, the coupon that was created on that plantation for you to give your life for is called the Argentinian peso. If you were born in Turkey, the coupon that you, just by virtue of you being born on that plantation, which we today call countries, you are forced to give your life over to a piece of paper called the Turkish lira. And this piece of paper was created by a small group of men. It is in the control. The supply of that piece of paper is in the control of that small group of men. They can dictate the price of this piece of paper. They can make the value go up and down on you. And of course, what they do is make it go down on you every single year, so that you have to work more the next year to get the same thing that the piece of paper purchased the year before. That is a form of slavery. And this is what Bitcoin has come to free us from. And you're asking me freedom from what? And so this is what I decided to dedicate my life to. Raising your level of sophistication, opening your eyes so that you don't ever have the question, Oliver, Bitcoin is freedom? Freedom from what? It sounds so weird to me now. It sounds weird that not more people see it this way, understand it this way. Bitcoin is a global money that was not created by a human being, a global money that is not run, operated, controlled, or manipulated, or or can be debased by any human being. In fact, human beings, instead of uh, you working for another man's money, this money pays human beings to protect it, to defend it. It is global. It is accessible to every human being on earth. It doesn't demand that you give your life to it. It is always available to you by choice. It is mathematically designed to go up in value every 4 years of its existence, which makes you freer and freer every 4 years of your life. You become more liberated, more free, more valuable. It is the most secure network the world has ever seen, which means that you can trust the most valuable thing that you have, the most valuable thing that you are with it, because there is nothing more secure on planet Earth than Bitcoin. That it is never down, never a hiccup, never sick at sea. It has never broken its promise. Its monetary policy is available for the entire world to see. Its monetary policy is mapped out for the next 100 plus years, all the way to the year 2140. It is the only thing on planet Earth, the only financial system on planet Earth that has a global worldwide audit. That audit is available for everyone to see, and that audit takes place on average every 10 minutes of its life forever. This money also that we call Bitcoin has stupefied the world. It has stupefied and shocked the world in such a way that no one really knows what to do with it, because what they're trying to do, even the voices in the Bitcoin space, what they're trying to do is fit something that does not fit any of our narratives, any of our frameworks, and they're trying to make it fit into our little squares, into our little circles that we already know. Bitcoin is beyond what we know. Bitcoin is beyond what we're used to. Bitcoin is beyond every single thing that you can possibly imagine. It can't be fit into our narratives. It can't be fit into our views, our beliefs. It's too big for that. No one knows what to do with a 15-year-old baby who's become the 9th, 10th most valuable asset the world has ever had in 15 years. No one knows what to do with that. No one knows what to do with the fact that there are 200 monies, 200 currencies in the world today. And in less than 15 years, Bitcoin has become the 16th most valuable currency in the entire world. Currencies that have existed for hundreds of years, some of which no one knows what to do with that. No one knows what to do with an asset that has the best performing record of anything in the history of the world. And the performance is so powerful, so mind-boggling that you can barely find numbers to put on it. Bitcoin's lifetime gain is something like 400 million%. No one knows what to do with that. Its 10-year gain is over half a million%. No one knows what to do with that. No one knows to do with an asset that has a CAGR, a cumulative annualized growth rate of 213%. And the next best asset the world has ever known has a CAGR of 16% over the past 10 years. 16% versus 213%. No one knows what to do with that. Where do you fit it? What circle does it fit in? What square does it fit in? What triangle does it fit in? It's like a bunch of little kids sitting around with their little wooden block puzzles trying to fit this strange shape that doesn't seem to have a hole for it. So I tell you all of this. I say all of that to simply say this. I'm trying to be that voice that makes you see Bitcoin this way. This is not just another asset, guys. This is life. This is freedom. This is not just something that you buy for $1 and sell it for $2 to go back to your comfy little jail cell or your comfy little plantation. This is something that once you adopt, it's for life. And I hope that over time, I can convince you that this is something that you do not sell. You do not get free from a declining, debased currency and then go back to the declining, debased currency that's going backwards. You don't sell a 213% CAGR asset to go to what? A 7% CAGR asset? What are you going to go? What do you sell it for? Sell it to go back to declining paper currency? And you've got 213% CAGR asset? So you sell it to go back to a declining piece of paper? Do you sell it to go back to a 16% CAGR? That's the second best. Do you sell a 213% asset to go back to a 7% CAGR asset? A 2% CAGR asset? A negative 20% CAGR asset? Like, what do you sell it for? What do you sell freedom for? What do you sell it for? What do you sell your future for? I want to be that voice, that very rare voice. I hope it stops being rare, by the way. I want to be that rare voice today that has you see this, like, see Bitcoin this way. All right, guys. I sort of like to start each one of my talks with a small monologue that actually precedes the bigger monologue. For those of you who are not familiar with my talks here, I do not pass the mic. I find that my style of delivery with my information and the small amount of knowledge I have is best done in the form of me giving a monologue, you coming up with questions throughout that monologue and asking them if you like, or asking your questions after. Maybe at some point in the future, I will have some guests or pass the mic to you, but I've just found that this is the most productive way for me at the current moment. So if you are going to ask for the mic, it is going to be for naught. I'm letting you know that up front. I will try to keep today brief, although I started off in a very lengthy way, so I apologize about that. But I get excited about this thing, man. I'm telling you. I want to welcome all of you who are joining in live to this talk. I think it's an interesting talk. I know your time is very valuable, especially during the holiday periods. And I'm hoping I'm going to be able to live up to your expectation to deliver something of value to you. Okay. So let us get started with our talk today. Why a 105% allocation to Bitcoin might be optimal. Now, this might seem to be somewhat strange to some of the people who are not really deeply entrenched in the financial world of leverage, but we're going to delve a little bit into why this might not be such a bad allocation for some. Now, no allocation is a blanket proper can be blanketed across every single human being on earth as being optimal. That can't be the case. No allocation is universally optimal for every single human being. But I just might surprise you that this allocation, a 105% allocation to Bitcoin, might be optimal for more people than you think. All right. So let's begin. All right. Now, in order for us to really lay the groundwork that's necessary to go into this topic, we have to talk about what portfolio asset allocation is. And I just want to do this so that we make sure that we are all on the same page here. So there are assets and then there are asset classes. And asset classes are basically little pockets of assets that are grouped they're grouped with or created, these groups are created with assets that are of a similar nature. So metals is an asset class, but gold is one asset in the asset class of metals. Okay. So you have gold, you have silver, you have copper, you have aluminum, you got titanium, yada, yada, yada. Right. And so you have assets and you have asset classes. Okay. You have stocks, and then you have, for instance, categories of stocks, semiconductor stocks. You have healthcare stocks. You have energy stocks. You have transportation stocks. But you can have groups in an asset class. You can have assets that make up groups, and then you can have groups that make up an asset class. Equities or stocks in general is an asset class. Semiconductor stocks, that's a group within an asset class. So you'll understand why getting these defined things down, why that's necessary before we delve into our 105% allocation talk. You'll understand in just a moment. All right. So there are assets, there are groups of assets. Sometimes these groups make up entire asset classes. And when it comes to proper portfolio theory, what a sophisticated market participant traditionally has wanted to do was to have some type of exposure to all of the key asset classes. And so the idea with traditional portfolio theory was that if I have a certain percentage of my available value, my available wealth spread out across every single proper and decent asset class, if I did do this in the right mixture, I can actually fare better than being too concentrated in one thing. That's how the traditional portfolio theory went. And so if I spread my wealth across some things that are a little more risky and some things that are more defensive, they would balance each other out, and so forth and so on. Now, the most popular asset class allocation really involved two giant asset classes: equities or stocks and bonds. This asset class combination basically became so popular, it ruled them all for 40, 50 years. And it's called the traditional 60-40 portfolio asset allocation model, 60-40. And what this asset allocation model basically encouraged people to do was to put 60% of their wealth in stocks, such as the S&P 500, which is a broad index that has become the gold standard to measuring what most stocks are experiencing. So a 60-40 split with 60% of your wealth put into the S&P 500 or stocks and 40% put into bonds, treasury bonds, U.S. government bonds. And you could do that through a bond fund. And so if you had $1,000 to invest, you'd put $600 in the S&P 500 and $400 in a bond fund. And this would, on average, protect you in almost any market, because in markets where equities are strong, bonds are more stabilized and don't do so well, but that is overcome by the 60% of your assets that are in the equity markets. And when equity markets have traditionally been soft and not performing very well, that has traditionally been when bonds have woken up and firmed and started to perform well. And so you had this sort of seesaw back and forth protective model. Equities perform on average better than bonds. You want to have a little bit more exposure to equities, but you also want to have some exposure to the stabilizing item called bonds that do well when your star equities don't do so well. And this 60-40 split worked for almost 50 years until recently, where it failed absolutely miserably. For the first time in the 60-40 split's life, it was one of the worst things you could possibly do during the year of 2022 into 2024. For the first time, this 60-40, this traditional thing that the entire world was sold on, failed the world. And it shook the financial industry at its core. You have to understand that when you sell a model for 40, 50 years, over that span of time, almost everyone who's anyone does it. It almost becomes somewhat of a self-fulfilling prophecy. And so an industry was built up around this 60-40 traditional split. What I mean by that is that money managers, asset allocators, basically sat in their offices and charged people 2% of their wealth without really ever truly telling them that all I'm going to do is take it and put 60% in equities, 40% in bonds, charge you 2%, and go play golf. That most of what people regard as a good record in the past by asset allocators, oh, this person did really well in the markets over the past 10 years, 15 years, 20 years. All they really did, when you lift the curtain, all they really did was take people's money, pretend they were smarter than they were, and put 60% in equities, 40% in bonds, charge them 2% annualized forever, and go play freaking golf. That's all they did. And they dressed up in nice suits. They put themselves in beautiful offices so that you thought that they were smarter than they were. But that's all they did, 60-40. And finally, it has failed them. It worked for years, but basically it's broken. It doesn't really work the way it used to work. All right, so now that we got that out of the way, Bitcoin is a new asset that's come on the scene since January of 2009. It's fought its way to be a recognized asset. It took years to do this, but there is no doubt today whether Bitcoin is a true asset or not. It's an asset. But what's really interesting is that it's also an asset class. You see, because Bitcoin did not just come into existence as an asset, it came into existence as an asset in a brand new category that never existed before. And for lack of a better term, let's call that digital asset class. All right? I don't really like that term, but okay. That's generally accepted. So this digital asset class never existed before Bitcoin. So Bitcoin is unique in that it's just not like a stock, a brand new company, a brand new stock arising in an already existing category called semiconductor, the semiconductor category. Here's a brand new semiconductor company that's gone public. There's a brand new semiconductor stock within an already existing category called semiconductor stocks. No, Bitcoin comes into existence as a brand new asset that is simultaneously creates a brand new asset class, digital assets. Now, this is very unique. It's extraordinarily rare. The last time something came into existence to create its own real true asset class was the stock market 200 plus years ago. New asset classes don't come into existence very frequently. Now, I know some people might go to bat with me on that and say, well, Oliver, the derivatives market, the options market, or whatever, I don't really count that as brand new asset classes because underlying other existing asset classes their existence depend on other asset classes. I'm talking about something that is purely brand new, that its life doesn't depend on anything else and sort of pops out of the ether into our world, into our existence. And the last time something like that really happened was the stock market 200 plus years ago. And the last time before that, it was the bond market, some odd 600 plus years ago. New asset classes don't come into existence very frequently. And that's another reason why I'm saying that we're amongst the most fortunate human beings to ever live, because we are living during a time where Bitcoin is born as a brand new asset, but not just that, as a brand new asset class. And so as a new asset and a new asset class, as it's becoming recognized as a new asset class, now the entire world has to sit down and say, well, if portfolio theory dictates that we have exposure in some small degree, to almost every major asset class, where does Bitcoin fit into this? Is it 1%? Is it 2%? Is it 3%? Is it 5%? But I am telling you, people, the entire financial world is sitting at desks today trying to figure this out. They understand that it is a brand new asset. They also understand it's a brand new asset class. They understand that as a brand new asset class, some money has to be given to it, but they're trying to figure out today what percentage of their overall wealth, their overall portfolio needs to be dedicated to this class. And a lot of people don't understand the enormity of this. What is going on behind closed doors right now as you speak? A lot of people don't understand why Bitcoin won't pull back, why it won't drop, because of what I'm explaining to you now. The world is ready to come into this brand new asset class at 1%, 2%, 3%, 5%, 10%. And I'm here to tell you sometimes as high as 85%. And we're here to talk about 105% today. Yes. So there is an entire world, the entire world of money is about to emerge, descend on Bitcoin between 1% and 105%. There's $900 trillion of value in the world as an estimate today, 900 trillion. So I want you to think about this. What percentage of 900 trillion over the years is going to be dedicated to the brand new asset class called Bitcoin? And I'm telling you, even the smallest percentages of that $900 trillion sends the USD denominated price of Bitcoin into the millions of dollars a coin. And some of you bozos want to think about selling and taking profits on a little pump. Pump for what? There's no pumps right now. You can't call a move from 16,000 to 44,000 a pump. What is that, a pump for ants? When we're talking about this thing is going into the millions of dollars a coin based on simple math, that $900 trillion has to decide what percentage of itself is it going to put into Bitcoin. This is not a choice. Do you understand? It's not a choice of whether or not these people have to put money into Bitcoin. They have to. The choice is what percentage, not if I put money into Bitcoin. No. You understand that no one can afford to not have Bitcoin if the rest of the world is going into Bitcoin for fear that they fall behind. That's game theory 101. If BlackRock's going into Bitcoin, that means everybody has got to go into Bitcoin. Do you understand how this works? They're not going to let BlackRock win that by that much by not going into it. That's not how the game works. So a percentage of $900 trillion has to go into Bitcoin. That is not a choice. What is going to be chosen is it 1% or is it 105% or is it anything in between? And so, guys, I'm telling you, some of you are still sleeping on this. You don't understand what's in front of us, and you don't understand the opportunity you have to front run what has to happen. This is not a gamble here. This is the most certain trade, the most certain play, the most certain wealth generating opportunity that you will ever have in your life, that maybe in the lives of all other future human beings that are going to be born over the next few thousand years. Can't imagine another opportunity like this ever coming into existence. It's crazy. But I digress. Okay, guys. So we've got this established that Bitcoin's a brand new asset and also at the same time a brand new asset class, and all asset classes have to be allocated to. That is not a choice. The only choice is that what percentage will it be allocated to? And I am telling you the range is going to be between 1% and 105%. And we're here to really focus on the 105%, but I still have to touch upon some things before we delve into that. That's going to be the cherry on top today. What is important to understand about this new asset called Bitcoin is that it is called or referred to in the traditional space as an 80 vol asset. Now, I find that when I mention this to most retail players or most people on X or whatever, because they're not really well trenched in the traditional financial world, they don't understand what an 80 vol asset is. And what that means is that it's ranked on a scale of 0 to 100. And ranking at 80% volatility is extremely high, as we know. So what does 80 vol asset means? It means that it's mathematically impossible to trade it consistently well and do well with it. So all of these bozos out here who are saying that they're trading Bitcoin back and forth on a short-term basis successfully and well, no professional worth his salt would ever believe that. Do you understand? That you cannot, it is mathematically impossible to trade an 80 vol asset consistently. You might get lucky. You might have several months of luck. You might have several weeks of luck. You might have several days of luck, but do it long enough and it's like the freaking these billion-dollar casinos. If they keep you in the casino gambling enough, you might get lucky here and there, but if you stay long enough, all of your money belongs to the casino. If you stay trading Bitcoin long enough, all of it will disappear. I promise you, it is basic maths, guys. You can't trade an 80 vol asset. So I'm telling you right now, anyone in this industry who's telling you that they're trading it hundreds of times back and forth and making more money than the hodler, they're a fucking liar. I am telling you this as a professional. You cannot trade an 80 vol asset unless you found some way to break the laws of frickin' mathematics. Impossible. So what do you do with an 80 vol asset? If the volatility is net positive to the upside, the only way to play it properly is to accumulate it. That's right, without selling it. To take the Warren Buffett approach to it for the most part. To use the declines as a way of measuring undervaluation and to ride out the rises. That's the only way to successfully play an 80 vol asset where the vast majority of the volatility is skewed to the upside. You accumulate and you don't sell. That's the only mathematical way that will win always. Always. The hodler will trounce the trader. The hodler will trounce every other form of market play with Bitcoin that you can ever imagine or come up with. Because mathematically speaking, the only way you can play an 80 vol asset with the vast majority of the volatility being to the upside is basically staying long and using declines to get more long. It's the only thing that works. Nothing else works with an 80 vol asset that is skewed to the upside. Professionals trade based on mathematical models, guys. They don't trade based on YouTube videos and stupid theories come up by 19-year-olds who claim to be experts in a market environment that's gone up their entire life. Guys, just trust me. 43 years in the business, I'm telling you, trading doesn't work on Bitcoin. And if it did, you don't think that I would be you think that I wouldn't be trading it? Some people refer to me as one of the most celebrated traders in this industry today. You don't think I would be trading Bitcoin if it could be done? It can't. All right. So we got that out of the way, that Bitcoin is an 80 vol asset. That is what it is referred to by everyone. And one quick and dirty way to understand what an 80 vol asset is that it on average will have an 80% decline. When its declines come, the average decline is 80%. That's not actually what specifically 80 vol means, but it's a quick and dirty way to understand it. Bitcoin's average decline after it peaks out is 80%. I want you to keep that number in your mind, 80%, which means that it can fall 85%, 89, 88%, but it can fall 68%, it can fall 72%, average 80% drawdown. That number I want you to write down. I want you to mark that. We're gonna circle back to that 80% decline number. Now, this volatility is declining though, cycle by cycle. So I can't think of the numbers off of my head, but I'm sure I'm pretty close. All right. Bitcoin's first decline was 95+%. I think it was close to 96% from its peak. These declines went from 96 to 88% decline to 84% decline, 78% decline, like that. It's waning. Do you understand? That's also important to understand. And this is natural. A brand new asset class will tend to be more volatile when it's young and less volatile as it becomes older. Weren't you more volatile at 15 than you are at 50? Weren't you? Weren't you more volatile as a human being when you were 12, when you were 10, when you were 8? What's the volatility of a dead man? Nothing. So think of birth. You're the most volatile. 5 years, you're volatile. You're a volatile little kid that can barely sit down for 5 minutes. And when you're dead, you have no volatility. And there are some assets that are close to being dead that have no volatility over 10-year periods, like gold. It's freaking 6,000 years old. Of course, it's near death. It's still doing a really decent job at maintaining itself, keeping itself alive, but volatility is largely gone today. But when it first came on the scene, it had the volatility of a Bitcoin. So Bitcoin is still young in its life. It's still relatively referred to as an 80 vol asset. Now, because of this, where am I going here with this? BlackRock had a report, an internal report that recently got leaked. And in this report, they were recommending that the traditional 60-40 split between stocks and equities, between equities or stocks and bonds, that this traditional model should be applied to Bitcoin. And so I want you to understand where they went with this, right? So for 40, 50 years, the traditional portfolio model split that worked the best was 60% equities and 40% bonds. But they decided that in this new world, Bitcoin is like the equity portion of your portfolio. It's the one with the alpha. It's the one that has the greatest potential. So it should be placed as the larger amount in your portfolio. And then they went to say, well, what's the bond equivalent when you're using Bitcoin as the equity or the stock equivalent? What's the bond equivalent? It's cash. So I want you to think about how ingenious this is. BlackRock said, we're going to replace the failing 60-40 split between stocks and bonds, and we're going to create a brand new one that will work for decade after decade after decade after decade. The same way that the last one worked for decades, this one's going to work for decades, if not longer. And the split they came up with was Bitcoin and cash, nothing else. The same way they recommended stocks and bonds and nothing else in the past. Well, it's a brand new world. It's the digital world. And the digital version of the traditional 60-40 split is now Bitcoin and cash. So I'm glad we got that established. Understand that's the two-pronged approach that BlackRock's report leaked. The new two-pronged approach is no longer stocks and bonds, it's Bitcoin and cash. Bitcoin represents what the stocks used to represent in that portfolio approach. Cash represents what bonds used to represent in the traditional approach. Now, they went further by saying that this two-pronged approach of Bitcoin and cash shouldn't just be 60% Bitcoin and 40% cash. It should actually be skewed more to Bitcoin. And the number was it was a weird number, but it was 84.99 something. I don't know why they didn't round it, but in the report, it literally had 84.9 something. And so we're going to round it for the sake of simplicity to 85%, right? So 85% allocation of your entire wealth, or what you're willing to dedicate to this particular asset class, you're going to have 85% Bitcoin and 15% cash. And that should get you through all of the ups and downs for Bitcoin. You can keep that ratio forever. Now, I want you to understand that when it comes to this portfolio approach to managing wealth, and trust me, guys, when you get into big numbers, it's portfolio allocation models that drive the wealth. It's not, I'm going to put some money in IBM and I'm going to put some money in Apple stock. They don't do it that way. It's too big for that. Do you understand? Big wealth operates on these allocation models. 60% equities, 40% bonds, 85% Bitcoin, 15% cash. Now, to maintain this 85 to 15% ratio does require periodic rebalancing of the portfolio, because if Bitcoin were to shoot up in value and become actually 95% of the portfolio balance and cash is reduced to 5%, then you have to rebalance, sell some Bitcoin down to the point where it becomes 85% and your cash goes up to 15% again. And so when you're using a portfolio allocation model like this, you do have to do periodic rebalancing. It is not a never sell approach. So yes, these big players will be selling Bitcoin when Bitcoin, if they want to stick to that 85%, 15% portfolio mix, they will have to sell Bitcoin down during the run-ups to bring it back in line with 85% and bring the cash back up. But they will also be buying Bitcoin. So during the downward drafts, they will buy Bitcoin to bring it up from falling to, let's say, 60% of the portfolio. They've got, it's now too far down, so they have to buy Bitcoin to bring it back up to maintain that 85% level. So it works both ways. Bitcoin gets a little too ahead of itself. They knock some off to bring it back down to 85%. Bitcoin falls a little too far, drops too far below the 85%. They buy more to bring it back up to the 85%. And this seesaw works back and forth, back and forth. Sell a little sum of Bitcoin to bring it back to 85%, buy a little more Bitcoin to bring it up to 85%, and you can maintain this mix forever. This is the portfolio allocation model. And it is how 99% of the wealth of the world is managed and handled. A lot of people aren't aware of the fact that BlackRock has officially produced reports that say that 85% Bitcoin and 15% cash is the perfect allocation. I'll try to add that to the show notes. All right. Where do you think this 85% 15 came from? If you remember what we talked about to lay the groundwork for this talk a little bit earlier, where does 85% come from? Well, it comes from the fact that Bitcoin's an 80 vol asset. You see, so if you can keep the allocation around that 80%, 85%, in fact, let's give it an extra 5%. That's where the 105% allocation model comes from too. It's a 5% surplus based on the nature of Bitcoin. So Bitcoin's an 80 vol asset. They have an 85% allocation to it. There's a 5% extra. Now, what's 5% extra of 100% allocation? 105% allocation. So this extra 5% model is actually rather standard. Going a little extra 5% actually increases your potential gain. An extra 5% edge increases your gain dramatically more than it introduces more risk. So you introduce virtually no new risk for supercharging your gains. 5% leverage or 5% extra does sort of add a turbocharge to your engine, but with virtually zero additional risk. So Bitcoin's an 80 vol asset. Let's add 5% to it. Let's get the turbo. Let's put the turbocharge it. Let's put that turbocharge on it. And I can see that happening in the BlackRock offices. Well, boss, Bitcoin's an 80 vol asset. Oh, really? Okay. Well, can we turbocharge it? Yeah, boss, we can turbocharge it. Well, let's turbocharge that thing. Turbocharge it. Slap that extra 5% on that bad boy. You know, that's how I'm imagining they talk in the BlackRock offices. Turbocharge it. Well, boss, what do you think about a 100% allocation? Let me think now. 100%, you say? Can we turbocharge it? Boss, I think we can. Well, let's turbocharge that thing. 105%. That's how I'm imagining they talk in the BlackRock offices. Turbocharge it. Guys, I crack my own self up sometimes. Turbocharge that thing. So yes, guys, I'm actually hearing from people. I still have some old contacts from the days, some people who are still very well entrenched in, Goldman Sachs, Morgan Stanley trading desks and stuff like that, BlackRock, Fidelity. And some of my contacts are saying that they've actually fleshed out a 105% allocation model to Bitcoin. And so this is how we're going to close out our talk today, talking about could a 105% allocation actually work for some people? And is that too risky? Now, I've already established that turbocharging it doesn't add by 5%, doesn't add additional risk. So the theory is if you're going to go 100%, then you should really just go 105% because that 5% turbocharge doesn't introduce any additional risk, but it adds a turbocharge to it. So if you're going to go 100%, if you're going to be 100% Bitcoin, basically, this theory suggests that why not just go 105%? What the heck? And some of you would say, Oliver, come on, man. You're talking about leverage here. The object is to stay solvent. Leverage has wrecked a lot of people. This is risky, Oliver. What are you doing? You're going out on the deep end saying if you're going to go 100%, you might as well go 105%. Well, let's take a look, shall we? Let's do that. All right. Now, let me explain this. I want you to understand that having a 105% allocation means that you're using leverage to invest more than your available capital, right? So you're using 5% leverage. So as an example, if you have $1,000 in your account and you use 5% leverage, that means that you're going to use $1,050. So you've got 1,000, you're going to leverage an additional $50. The $50 you don't have, that's the leverage part, right? Now I'm using simple numbers, guys. I want you to imagine that these guys are going to do this with huge numbers. All right. $1,000, 105% allocation is $1,050. Now, to avoid liquidation in a leveraged situation, you need to maintain a certain level of margin in your account, right? So margin is like the collateral that you deposit to open a leveraged position. So no one's going to give you going to give you more than what you have unless you secure them with some portion of something. You're going to have to put some margin up, right? Now, there are different margin requirements from platform to platform, but a common one is 105%. So this means that the value of your account must not fall when you do a 105% allocation to an asset like Bitcoin. It means that if you're going to use a margin of 105%, this means that the value of your account must not fall below 105% of the margin. Otherwise, liquidation will occur. Now, there's a formula for this, and maybe I'll type it out for you when I finish this. It's a basic margin to leverage ratio formula. It's used across the industry. All right. Now, using this formula with a margin of 1,000, a leverage position of 5%, a margin requirement of 105%, guess what? This means that Bitcoin's price would have to drop to zero and then go negative by $2,000 to get liquidated. Did you hear what I just said? To have a 105% exposure to Bitcoin on margin, Bitcoin, to get liquidated, Bitcoin would have to not only decline all the way to zero, it would have to go negative 2,000 to get liquidated. Now, how is that possible? Are you starting to see or understand what I'm getting at here? That extra 5% turbocharge doesn't introduce any new risk, but it adds a turbocharge to your overall position. Bitcoin's not going to zero, guys. It's an 80 vol asset. It's not a 100 vol asset. It doesn't go to zero. Do you understand? Bitcoin, if it did go to zero, it can't go to negative 2,000. Even if it went to zero, you wouldn't be liquidated. That's crazy. In your leverage position. And so I'm hoping that you understand this 5% turbocharge theory, that leverage that low does give you an extra kicker, but it doesn't introduce one iota of extra risk to the position. So now do you understand why those who want all in on Bitcoin, all in for them means 105%? It doesn't mean 100%. Not in the professional world. And maybe, just maybe, check with your advisor. Not in your world either. Crazy, right? How freaking crazy is that? That you can turbocharge this thing without any additional risk. Powerful or no? What do you think? Talk to me. Talk to me. I know we've got the doubters out there, but Oliver, that's how the doubters sound to me. Every time I read their comment, but Oliver, what about this? And Oliver, what about this? But I'm so worried, Oliver. What if, but, and what about that? That's how you guys sound. Exactly. Why do all the doubters sound the same way? I don't understand that. But Oliver. Do no harm says, Oliver, I have a piece of real estate that is controlled by a general partner. If I could sell out, I'd put it in Bitcoin. The rest of my assets and more, about 110%, is in Bitcoin. Who needs BlackRock to tell me? Oh, nice. So do no harm. You're doing the same thing. Now, guys, listen to this. If Bitcoin is an 80 vol asset and it's actually that volatility ratio is waning over time, then you're, statistically speaking, you're pretty safe at a 10% margin position, certainly a 5% margin position, and maybe all the way up to about a 12% margin position. That the odds of at any point a drawdown knocking you out of the box is very, 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 the odds are infinitesimally small. It's not impossible, but it's small. And if you have cash flow, then if you have cash flow in your life, then you almost remove all the risk with up to like 15% margin, right? Because if you were to ever approach liquidation level, if you've got enough cash to just put up to give yourself another 10% room all the way to 95%, you eliminate the risk. So margin definitely gets a bad rap because the majority of idiots out there use it incorrectly. But if you know simple maths and you know the volatility ratio of the asset that you're dealing with, you can structure some very intelligent leverage models that give you that turbocharge. They give you that turbocharge to an asset. I've been doing this my whole professional life. That no one in my field does 1-to-1. Like, no one does that. It's dumb, right? Not if you can add the turbocharge with no risk. But you can't, where leverage gets a bad rap is that the vast majority of people are degenerate gamblers. So they're doing 4-to-1. That's the other way. That's just dumb. Well, now 4-to-1 is not maybe that bad. They're doing like 100-to-1 leverage. Do you know 100-to-1? The item moves a penny and you're out. That's stupid. Being a bit facetious, but you 1% move and you're gone. That's just stupid. That's dumb, right? And these platforms out there that allow 100-to-1 leverage, like Binance used to do, and FTX, I think in the beginning days, and all of these offshore exchanges, which these crazy numbers would never be allowed in the States, right? But all they're really, professionals look at that and say they're not even placing the trade. Any exchange that's willing to give you 100-to-1, they know you're a guaranteed loser. They don't even put the trade in. You might see the trade electronically on your screen, but they just put you deposit and they put that in their pocket. They don't even bother. They're not under any regulatory pressure to actually do the trade. So because the statistics are that you're going to lose with 100 to 1 leverage 99.9999% of the time. Why even bother? Your deposit into the account is their gain. Why should they actually place the trade with odds like that and make their gain less through fees? They're not going to do it. They're going to pocket your deposit. Your deposit is their gain, and they're not even going to place the trade. And that's what's going on in a lot of these offshore exchanges, guys. They're not really placing trades for you. You do understand this, right? That is why they operate in the offshore market and don't bring their successful businesses to the United States, where the biggest market in the world exists. Why do you think they don't want to be in the biggest market? If you had a successful business model, wouldn't you want to bring it to the biggest market in the world? Why do you think they don't want to bring it to the biggest market in the world? Because they're not placing your trades. That's why. Your deposits are just they consider it their money, and they're letting the numbers work. Why do you think that when these overly leveraged degenerate gamblers get too piled up on one side, it's the exchanges that trigger them? It's just an automatic way. Okay, let's lock the money that we already took in our pocket. Let's lock it in now. Leader Fresh is saying the spot ETFs will have their respective inverse ETFs at the same time of the approval. I don't think so. I could be wrong with that, but I don't think that there's approval. I don't think that there will be simultaneous approval of inverse ETFs. But guys, the ETFs that are coming into play are that these are going to be very valuable instruments for us because they can allow us to professionally hedge some of our Bitcoin position sometimes. And you know what? Let me mention something that I think I failed to actually mention in my introduction to this talk today. Guys, I was a client of for years. I was a client of Fidelity and Morgan Stanley, right? And I'm talking about sort of like an institutional style client, right? So I had a portfolio of stocks, a wealth portfolio is what I call it. And, I had, major positions in things like McDonald's from the late 1980s. I had Microsoft from the late 1980s, early 1990s. I had Apple from 97. And, it was just and the portfolio was very sizable. So when I went to Morgan Stanley with my portfolio, they literally gave me a checkbook. I'm telling you, literally, it was early enough where you still got a checkbook. I got a checkbook. By ACATing my portfolio to Morgan Stanley, I got a checkbook. This checkbook gave me the ability to write any amount on the check that I wanted to use or cash for myself. I could purchase anything with it. I could cash out up to 85% of my portfolio. Think about this. I got a checkbook that gave me the ability to write checks up to 85% of my entire portfolio. Are you seeing where this 85%, 15% cash model is coming from? This is Wall Street, guys. It's a freaking Wall Street model. So they considered 85%. They considered having 15% leeway if they ever had to liquidate. Now, if they ever had to liquidate, they'd be okay. for the most part, that my portfolio was of a certain caliber, at a certain amount, was at a certain caliber, where me leveraging at 85% was not going to put the portfolio in danger of being liquidated. And so, the ETFs, right? Oh, before I leave that point, all right. So, why this works on average, if you have a portfolio or an item that is statistically proven to go up over time, and the S&P 500, the stocks are statistically proven to rise in value about 8 to 9% a year. All right. But if you have an asset that goes up over time, that your leverage position becomes less and less risky over time. And so by taking out leverage against my portfolio, if I took out 85% out of the portfolio, and I wanted to buy a plane with it, and also buy a yacht with it, and a little mini mansion in Italy or whatever, and I I wrote 85% check against my overall portfolio. Well, over time, 85% next year would be 75%, maybe. And a good year, maybe it dropped to 50%, because the value of the portfolio rises in relationship to the amount of leverage that I took out of the system, out of it. And so over time, the portfolio itself could literally pay for what I pulled out of it. Over time, that 85% goes to 72%, goes to 60%, goes to 51%, goes to 43%, goes to 20%, goes to 15%, goes to 10%, goes to 5%. As the value of the portfolio rises, the percentage, the ratio of what I have on leverage gets smaller. And that's what people are going to be doing with Bitcoin. It's mathematically guaranteed to go up in value every 4 years of its life. This makes it more certain than what they used to do with my wealth portfolio. And so these are some powerful things. And when you bring an ETF into the equation, you see an ETF, the shares are registered securities. And under certain regulations, you can go 20 to 1 with a regular security in the professional world. So I want you to think about this. If I buy in the professional world, if I buy shares in the Bitcoin ETF and I post those shares if I post those shares as collateral, I can get 20 times the value of those shares. So if I buy $1 million in Bitcoin ETF shares, I can post that and get $20 million of buying power. And banks and things of that nature are going to want to, companies and corporate treasuries are going to want to hold this on their balance sheet because of that elasticity, that 20 to 1 elasticity that they can apply to the registered security that is based on the underlying asset. They can't do that with straight Bitcoin, but they can do that with the ETF shares. There's going to be a lot of things that are played around with that are going to require that somebody actually has the underlying sitting there supporting all of this. All right. Wow, Steve says listening from Kenya, Africa. He wants someone to donate some coins to him. Turbocharge that thing, Steve. Turbocharge it. Vikingo says, damn, man, you got this turbocharge stuck in my head. All right. Somebody's saying, well, 5% upside doesn't sound that appealing. Make the case for it, please. Maybe this was just a lot earlier. Well, no, it says 14 minutes. So I don't know if you came in late Sats minded, but we're talking about really an asset that already with no turbocharge attached to it is stupefying. So when you say adding 5% to it, you basically miss the whole thing. 5% is exponential, really. You know, this is not going to appeal to the degenerate gambler's mind, because the degenerate gambler wants to go to the point where they are guaranteed to be destroyed. That's what gives them their adrenaline rush. This is professional market play. Professionals understand that over a lifetime, holding that 5% leverage position gets you exponentially more Bitcoin than the person who doesn't do that. And so it does it without introducing one iota of extra risk to the equation. And that's very powerful. You know, guys, it's the penny effect, right? This is what the novice minds don't understand. It's the penny effect. You've heard of this. You've heard of this saying. You've heard of this common repeated scenario as if you double a penny every single day of an entire month. So on day one, it starts with a penny. Day two, it starts with 2 pennies. Day three, it starts with is 4 pennies. And day 4, it's 8 pennies. And day 6, it's 16 pennies. If you double it every single day for 30 days, you have millions and millions and millions of dollars on day 30, right? And this 5%, it's not doubling, but it has that same effect. Over many cycles of Bitcoin, that 5% just starts compounding and compounding, and OMG. At the end of a decent period of time, you will leave anyone behind that's just doing straight 1-to-1. And you will have done it without introducing a single ounce of extra strength, extra risk to the equation. Now, I will end by saying this, guys. I will end by saying this. If you happen to be fortunate enough, guys, to have cash flow, if you live a cash flow life, and that is, I'm blessed to live a cash flow life. There's just new dirty fiat showing up virtually every 5-10 minutes of my life, 24 hours a day. I'm fortunate to have built that, which is a constant flow. I can't stop it from coming. And that is one of the main reasons why I buy Bitcoin almost every single day of my life. It's like, what am I going to do with this dirty fiat? Turbocharge it, Oliver. Turbocharge. So anyway, if you happen to have built a cash flow life, and this cash flow is secure for you, then you really are in the position to take advantage of things like this. That you can apply, you are in the best position to apply intelligent leverage to where you can't be liquidated because of your cash flow. And so as long as you have the wherewithal to, if you were to do 85, 15, if you were to go leverage 15%, and Bitcoin is an 80 vol asset, the odds of just being liquidated are already very small, even if you were to do it from the very tippy top of a bull run. The odds of being liquidated are low. And if you've got cash flow, even if it got close, you just post cash and move it to 95%. And so you're very sophisticated, not even very, you're somewhat sophisticated players are going to play it like this. I'm telling you. And the entire financial system is going to, an entire financial ecosystem is going to grow up around Bitcoin that offers this to wealthy people and family offices and institutions and corporations. They're going to play it like this, guys. And it is going to drive Bitcoin's US dollar denominated price into the millions upon millions of dollars a coin. So get ready. Just get ready for it. All right, I want you guys to say it for me, though. Can you say it for me? Turbocharge that thing. Boss, what do you think about 100%? 100%, same. 100% allocation, huh? Can we turbocharge it? Yes, boss, I think we can. Well, turbocharge that thing. All right, guys. Listen, I hope I wasn't all over the place. I hope I've shared something of value to you today. I know that I'm always saying this, but I have to remind you that I do appreciate all of you so very much that you show up. You give me the most precious commodity that you have, which is your time. Thank you very much for giving me your time here today to listen to me banter and talk and joke around, what have you. But I hope in my bantering and talking and joking around, you got something of value. I hope I've left you with something to think about, something to ponder, something to entice you to continue to investigate and go deeper and deeper down this rabbit hole. All right. I appreciate it. If I failed in some way to do that, keep your interest or to give you something to truly ponder, I'll try to do better next time. Each time I'm given the opportunity to speak to you, I'm going to try to get better and better. I promise. All right. Meantime, guys, you know what to do. Go to work. Go to work. Turbocharge that thing. All right, guys. Ciao for now. Boom.
My name is Oliver Velez, and I am your 13%er Bitcoiner. Be safe out there, and until next time. Boom!